Financial theories. The aim of this unit is to provide learners with knowledge of key financial theories and working capital management, and the skills to review techniques for managing an organization's global financial risk. Financial management scope and control, objectives, functions, financial control. Financial management is about planning, organizing, directing, and controlling financial activities like procurement and use of funds. It ensures that a business uses its financial resources efficiently and aligns spending with strategic goals. Financial planning. This involves forecasting the financial needs of the business. It includes estimating capital requirements, deciding capital structure, creating budgets and financial strategies. Goal. Ensure the business never runs out of cash and can fund growth. These are decisions about where to put the firm's money to get the best returns. Capital budgeting, long-term investments like equipment, property. Working capital decisions, managing short-term assets and liabilities. Goal, maximize return on investment while managing risk. This is about deciding how to raise funds to finance operations or growth, choosing between equity, debt, or a mix. Evaluating cost of capital and risk. Goal, minimize cost of capital and maintain control over the business. Financial managers decide how much of the profit should be reinvested in the business or paid out to shareholders. Goal, balance between rewarding shareholders and funding future growth. This is day-to-day financial management, monitoring inflows and outflows, ensuring the business can meet short-term obligations, avoiding liquidity problems. Goal, maintain healthy cash flow to avoid disruptions. This includes budget control, performance analysis, and internal audits. Goal, track performance, prevent fraud, and ensure accountability. Analysis. Effective financial management helps keep the business solvent, support strategic decision-making, attract investors or secure loans, improve profitability and long-term value. Financial management in business refers to the planning, organizing, and controlling of financial resources to achieve the organization's objectives. It plays a central role in decision-making across all levels and ensures that money is being used efficiently and responsibly. Investment decisions focus on how the business allocates funds to generate future returns. These can be split into non-current assets and net current assets. Control aspect, use of techniques like net present value and internal rate of return to evaluate options. Financial decisions involve choosing how the business raises capital to fund operations or growth. This could come from equity finance or debt finance. Control aspect, monitoring interest costs, repayment schedules, and debt covenants. Once the business earns a profit, management must decide how to allocate it between reinvestment and returns to shareholders. Control aspect. Dividend policies and board approvals ensure distribution decisions are aligned with long-term goals. The primary goal of financial management is to ensure the financial health and sustainability of a business while supporting its strategic growth. Ensuring financial health and sustainability in business growth supports business growth and financial health management strategic growth. Operational functions in financial management are the day-to-day activities that keep the financial side of the business running smoothly. These functions focus on managing money effectively, making investment decisions, securing funding, and maintaining control over financial performance. Treasury management is responsible for managing the company's financial assets and liabilities. This includes making short-term and long-term investment decisions and managing financial risks. Before raising or investing money, the business must know how much it actually needs. This involves forecasting costs for expansion, equipment, staffing, or marketing. Once capital needs are known, the next step is sourcing the money. This includes identifying and choosing the right sources of finance, evaluating terms, and balancing debt and equity. Thank you. This is about managing short-term financial health, keeping the lights on and the business running day to day. It involves managing receivables, controlling payables, maintaining adequate cash reserves, and monitoring inventory levels.